You know that feeling, right? You're scrolling through the news, financial headlines just pulling you every which way. One minute it's recession risk is back, the next it's market hits new highs. It's confusing. You just want like a straight answer on what's really happening.
Oh, absolutely. It's information overload, isn't it? Trying to find the signal and all that noise.
Exactly. Well, that's what we're doing today in this deep dive. We're aiming to cut through that noise specifically for you, our listener. We want to give you a really clear understanding of something critical, the whole macroeconomic picture and what it might mean for the U.S. stock market in 2025.
And to do that, we're digging into a specific professional report. It's titled Macroeconomic Headwinds, Stock Market Impact Analysis 2025. It's dated June 25, 2025, prepared for, informed investors. So it's pretty detailed stuff.
Right. So our mission here is simple. Pull out the most crucial bits of insight from this report. Help you understand the big forces at play, what it means for stocks, but without, drowning you in jargon or overwhelming detail. Ready to jump in?
Let's do it. So starting with the big picture, the report's executive summary. It doesn't exactly paint a super rosy picture. It describes the environment as, well, complex and pretty challenging for the U.S. stock market right now.
Okay, complex and challenging. What are the main things making it so tough? What are the headwinds they call out?
They point to a few key things. First, economic growth is noticeably slowing down. Then you've got the Federal Reserve's monetary policy. It's still restrictive, keeping interest rates high. And consumer sentiment, generally weakening.
Slowing growth, high rates, consumers feeling less confident. That sounds like a tough mix. Is there anything positive balancing that out? Or is it all negative?
There is one really crucial counterbalance they mention, the labor market. It is cooling off a bit, which is actually needed, but it's staying remarkably resilient overall.
Ah, okay. So people are still working, largely.
Exactly. And that resilience is what keeps that soft landing idea alive. The hope that the economy slows down enough to beat inflation, but without a really damaging recession. That's a key point. Got it. So it's like a tug of war. Slowing growth on one side, but the strong job market pulling the other way. The report's key findings probably dig into that more. Let's start with slowing growth. What's the evidence there?
Well, they mentioned the Q1 GDP figures, that's gross domestic product, got revised downwards, and other indicators looking forward. They seem pretty weak, too. So the forecast is for continued kind of sluggish growth through the rest of 2025, which naturally is a direct challenge for companies trying to grow their revenue and profits.
Right. Less economic activity means potentially less money coming in for businesses. And that ties into the Fed, doesn't it? The restrictive monetary policy. You said the report calls this the most significant headwind.
It does. That higher for longer stance on interest rates is really the big one. Keeping borrowing costs up puts pressure on stock valuations, makes them look less attractive compared to, say, bonds. Plus, it makes businesses maybe think twice about investing, and the report anticipates only one rate cut, probably late in the year. That's a big forecast. One cut, late in the year. Okay. And what about things happening outside the U.S., the global and geopolitical headwinds?
Yeah, that's another layer. Weakness in places like China and Europe, plus a strong U.S. dollar, which makes U.S. goods more expensive abroad, and, ongoing geopolitical tensions. All of that adds risk and can hurt the earnings of big multinational companies that rely on global sales.
Okay, so putting that executive summary together, what's the overall verdict for the stock market according to this report? Leaning positive, negative?
The conclusion is that the macroeconomic factors right now tilt negative for stocks. Thanks to that resilient labor market, the chance of a really deep recession seems lower, which is good. But the path ahead looks like, well, constrained growth and higher than usual risk. Not a disaster, but certainly not a boom time.
Okay, that sets the stage really well. Now, you mentioned the report gets specific using a rating scale.
Yes, exactly. They rate key economic indicators from 1 to 5. 1 is highly negative, 5 is highly positive. It gives a nice structured way to see how they weigh different factors.
Great, let's use that structure. First up, economic growth and output. The report gives this a rating 2, which is negative. What specifics lead to that rating?
Right, a 2. So as we touched on, Q1 2025 GDP got revised down to 1.4%. And May retail sales figures, they were pretty weak, up only 0.1%. The forecast for the second half of the year is also sluggish, maybe 1.0% to 1.5% growth. So definitely decelerating.
And remind us why that slow growth matters so much for stocks.
Well, it directly hits companies' top lines, their revenues. If the overall economy isn't growing much, it's harder for companies to expand their earnings. That puts a damper on stock price potential. Although sometimes this pressure forces companies to get really efficient. So lean operators might still do okay.
Interesting point. Okay, next, monetary policy and interest rates, also a rating 2 negative, and you said this was the biggest factor.
Definitely the most significant headwind, yes. The Fed funds rate is sitting there at 5.25% to 5.50%. And the FOMC, the committee setting the rates, they're projecting just that one single cut in 2025. And the market doesn't even seem fully convinced it'll happen before, say, November.
So higher for longer isn't just talk, it's baked into the forecast. What's the direct impact on my portfolio or on valuations?
Two main things. One, higher interest rates increase the discount rate used to value future earnings. Put simply, future profits are worth less today, making stocks look less appealing relative to safer things like bonds. Two, higher borrowing costs make it more expensive for companies to borrow money for expansion or investment, which can slow down their growth.
Okay, that's clear. So the Fed's actions and slow growth, how are people feeling about this? Which brings us to consumer and business sentiment, also rated 2 negative.
Yeah, sentiment is pretty low. The June consumer sentiment numbers hit a multi-month low. And the report expects sentiment to stay kind of depressed until there's a really clear sign the Fed is starting to ease up on rates. People are feeling pessimistic.
And why is that pessimism such a big deal? It's just feelings, right?
Well, yes, but consumer sentiment is a really important leading indicator. If people feel worried about the economy or their jobs, they tend to cut back on spending. And since consumer spending is such a huge part of the U.S. economy, that pullback poses a significant risk to earnings, especially for companies selling directly to consumers. It can become a bit of a self-fulfilling thing.
Right, if everyone expects things to be bad, they act in ways that make things bad. What about the housing market? That's another rating 2 negative. Still mostly about mortgage rates.
Pretty much. Mortgage rates are hovering near 7.05%. Ouch. And existing home sales, they just keep falling. The report doesn't see any significant recovery happening in 2025. It's looking like a prolonged slump.
And the ripple effect of a slow housing market, how does that impact the broader economy?
It drags on GDP directly through lower construction activity and less spending on related things: furniture, appliances, renovations. Plus, there's a negative wealth effect. If people's biggest asset, their home, isn't gaining value or even losing value, they feel less wealthy and might cut back on spending elsewhere too.
Okay, so we've got domestic pressures, but you mentioned global factors too. International factors also get a rating 2 negative. What's happening internationally?
It's a combination. You've got weak economic data coming out of key regions like China and Europe. At the same time, the U.S. dollar is strong, which actually makes American exports more expensive for buyers in other countries.
Yeah.
The overall forecast is just for continued sluggish growth in most other advanced economies.
And for those big U.S. companies that sell globally, that's a double whammy.
Exactly. A huge chunk of the S&P 500 is made up of multinational corporations. For them, this means weaker demand from overseas customers, and their foreign profits translate back into fewer dollars when the dollar is strong. It directly eats it into their bottom line.
Okay, and then there's the wild card. Geopolitical risk, also a rating 2 negative. What are the specific concerns here?
The report points to the ongoing protracted conflicts, particularly in Europe and the Middle East. The forecast isn't for resolution, but rather for a sustained period of high tension, with the constant risk of things suddenly flaring up.
And how does that background tension affect the market day to day?
It forces investors to demand a higher risk premium for holding stocks. Basically, you need a potentially higher return to compensate for that extra uncertainty. Plus, there's always the looming threat of disruptions to supply chains, energy prices, trade routes. That weighs on confidence and can spark volatility.
Wow, okay, that's a lot of rating 2s, a lot of negative factors.
Yeah.
Are there any neutral or positive spots in this analysis?
Yes, there are a couple neutrals and one clear positive. Let's start with inflation and prices. This gets a rating 3 neutral.
Neutral. So inflation isn't a major negative anymore.
Well, the trend is better. May's CPI, the main inflation measure, was at 3.2% year over year. That's down from the peaks. And the forecast is for core PCE, that's the Fed's preferred measure, to slowly drift down towards maybe 2.8% by year end. So disinflation is happening. That's positive because it reduces the pressure for more rate hikes.
But why only neutral then, if it's going down?
Because it's still expected to be above the Fed's 2% target by year end. So while the trend is good, it's not quite good enough for the Fed to confidently pivot to cutting rates aggressively. It keeps policy restrictive for longer. Hence, neutral, not actively bad, but not sparking a policy change either.
Got it. Okay. What about domestic fiscal policy? Also rating 3 neutral. What's the story there?
Right now, it's mostly characterized by legislative gridlock in Washington and a pretty high budget deficit. Looking ahead, the report flags increasing uncertainty as we head towards the November election.
So politics isn't a huge driver for the market at this moment, but could become one later.
That's the assessment. It's not seen as a primary headwind or tailwind right now. But yeah, definitely something to keep an eye on as the election gets closer. Political uncertainty could certainly ramp up.
Okay, now for the bright spot you mentioned. After all those negatives and neutrals, we have the employment and labor market with a rating for positive. What makes it stand out?
This is really the anchor for the economy right now. May saw 210,000 jobs added, which is still solid. Unemployment ticked up slightly to 4.0%, but that's still very low historically. The forecast is for it to cool a bit more, maybe unemployment drifting towards 4.2%, job gains moderating. But still fundamentally strong.
It really does feel like the odd one out here. Why is this strong labor market so crucial, and is there any risk it's too strong?
It's crucial because it supports consumer spending. People with jobs spend money. It's the core pillar of that soft landing narrative. It seems to be cooling just enough to ease worries about wage-driven inflation getting out of control, but it's strong enough to prevent the economy from falling off a cliff. It's a very fine balance, but right now, it's holding. Could it be too strong? Maybe earlier that was a concern, pushing inflation. But now, its resilience is seen mostly as a buffer against all those other negative forces we discussed.
Fascinating balance. Okay, so let's connect all these dots. We've gone through the ratings, the details. What's the report's final conclusion, the strategic outlook for the rest of 2025?
Well, pulling it all together, the report emphasizes that core tension, the resilient labor market pushing back against slowing growth, and that restrictive Fed policy. This push and pull is expected to be the main story for the rest of the year.
So that soft landing is still possible, but the higher for longer rates are kind of keeping a lid on things.
Exactly. The report suggests the soft landing scenario is definitely plausible, but its positive impact is being actively suppressed by those high interest rates. It limits the market's potential upside.
Given that tension, what are the key things investors really need to watch out for? The big risks that could derail this outlook.
The report flags 3 main ones. First, if that strong labor market suddenly weakens much faster than expected, that could quickly shift the story from soft landing to recession. Second, if inflation unexpectedly picks up speed again, that would kill any hope of rate cuts in 2025 and likely hit the market hard. And third, a major escalation in geopolitical conflicts. Think something causing a big spike in global energy prices. That could disrupt everything.
Okay, those are serious risks. On the flip side, are there any potential positive surprises? Things that could make the outlook better?
Yes, they mention a couple of possibilities. If we get a string of really good, lower than expected inflation reports, that could make the Fed rethink its timeline for rate cuts, maybe bringing them forward. That would likely boost the market. Or, perhaps less likely but impactful, a clear, peaceful resolution to one of the major geopolitical conflicts could significantly lower that risk premium we talked about.
Right. So with all this complexity, the headwinds, the one positive, the risks, the potential catalysts, what's the bottom line advice for you, the investor, listening right now? How should you position yourself?
The report's advice is pretty clear. Adopt a cautious and defensive posture. Focus on quality. Prioritize companies with strong balance sheets, meaning not too much debt-resilient profit margins, and business models that can hold up reasonably well even if the economy stays sluggish. Think stability over chasing high-flying growth in this environment.
That makes a lot of sense. Cautious, defensive, focus on quality. Well, this has been incredibly helpful. We've really unpacked this complex macroeconomic picture, looked at the specific headwinds from the report, and hopefully given you a much clearer, more informed perspective on what might shape the stock market in 2025. We cut through some noise.
Hopefully so. And maybe one final thought to leave you with, building on all this. In an environment like this, with so many documented headwinds and really just one clear positive factor, how much weight should we give to the perception of those risks? Could it be that how investors feel about the risks, how they perceive the uncertainty, might actually end up shaping market behavior more than any single data point itself? Something to think about.
That is a really interesting point. Perception versus reality in the markets. Definitely food for thought. We really encourage you to keep watching these themes unfold, see how the upcoming economic data lines up with these forecasts, or maybe where it starts to diverge. Keep that critical thinking going.